What if I told you that the company where you go to, buy a $10 hammer and maybe some weekend mulch is quietly transforming, like transforming into a $1.2 trillion logistics empire?
I mean, it sounds totally absurd when you frame it like that.
It does, but today we are tearing down the walls on Home Depot. Welcome to this Talk Tickers Deep Dive.
Glad to be here. And if you're joining us, you probably know the mission by now.
Right. Our goal is to take these massive corporate earnings calls, the raw audio, the management slides, that tense Q&A with Wall Street analysts, and translate it all for you, the retail investor.
Exactly. We're going data forward today, but we're also stripping out the jargon.
No Wall Street speak, just plain English. And we're going to take a really opinionated stance on these results. We want to leave you with actionable insights for your own portfolio.
We are dissecting Home Depot's first quarter 2026 earnings call today. Ticker symbol HD.
And HD isn't just a retail stock, right? It's it's a weather vane.
Oh, it's a total bellwether. When Home Depot reports earnings, you are essentially getting a real-time pulse check on the American consumer.
Yeah, the health of the housing market, the macro climate, all of it.
Right. It's all baked into how many 2x4s people are buying.
So let's get right into the structural blueprints. Let's look at those top line numbers because the scale here is it's difficult to wrap your head around, honestly.
Yeah, it really is.
For the first quarter, management reported total sales of $41.8 billion.
Billion with a B.
With a B, that's
Wow.
Increase of 4.8%. So roughly $1.9 billion in new revenue compared to the exact same 3-month period last year.
Which is just a staggering amount of volume. They moved nearly $42 billion worth of lumber and paint and power tools in 90 days.
90 days.
To put that in perspective for you, there are entire sovereign nations that do not generate $42 billion in gross domestic product in a whole year.
Wow. Yeah, that really puts it into context. But top line revenue only tells you how much cash actually flowed into the registers, right?
Oh. Exactly. It's just the gross intake.
To figure out what survives that journey, the income statement, what actually benefits you, the shareholder, we have to look at the EPS, the earnings per share.
And this is where the accounting gets a little bit messy.
Yeah, we definitely need to translate this part. So management reported an adjusted diluted earnings per share of $3.43 for the quarter.
Right.
Which is down slightly from the $3.56 they reported in Q1 of last year. But then there's the official GAAP number.
The strict legally mandated accounting number.
Right. The GAAP EPS came in lower at $3.30. So we have this adjusted operational number of $3.43 and the strict accounting number of $3.30.
Which is a pretty noticeable gap.
It is, and management explicitly said that this gap is largely due to a $171 million pre-tax intangible asset amortization.
Okay, and I know when you hear a phrase like intangible asset amortization, your instinct is just to hit fast forward on this deep dive.
Honestly, my eyes glazed over reading it the first time.
Right, but understanding this is so crucial if you want to know how Wall Street values aggressive companies.
So break that down for us. What does that actually mean in plain English?
Think about it this way. When a massive entity like Home Depot acquires another business, and, spoiler alert, their recent acquisitions are the biggest story of this quarter, they aren't just buying physical stuff.
Like forklifts and warehouse racks.
Exactly. They aren't just buying inventory. They are paying a huge premium for brand reputation, customer lists, proprietary software, vendor relationships.
Things you can't touch.
Right. Those are intangible assets. You cannot physically hold a vendor relationship in your hand, but it has immense financial value to the company.
But the accounting rules don't just let you slap a vague concept like brand value on the balance sheet forever, right?
No, the SEC would not love that. The official accounting rules force companies to slowly bleed off or amortize the cost of those invisible assets over time.
So it's basically a depreciation schedule, but for things you can't touch.
That is the perfect way to describe it. So that $171 million charge hits their official bottom line. It drags the GAAP number down to $3.30.
But that wasn't actual cash leaving the building.
Exactly. That's why management and the analysts want you to look at the adjusted $3.43 number. That $171 million wasn't cash flying out of Home Depot's bank account this quarter. It's a paper expense.
A paper expense. Okay.
Yeah.
So the adjusted number gives you a much clearer lens into the actual daily cash generating power of the business.
Right. It's an accounting ghost. It's not an operational failure.
Okay, that makes sense. So I want to pivot from the sheer size of the revenue to the actual organic health of the stores, which means we have to talk about comps.
Comparable sales, the ultimate retail metric.
Yes. Total company comps came in at positive 0.6%. U.S. comps were positive 0.4%.
Which doesn't sound like much, but honestly, the broader retail sector is bleeding right now.
Yeah, competitors are posting negative comps across the board, so squeezing out any positive number is a huge victory for them.
It really is.
But I want to linger on this concept for a second.
Right.
Because if total revenue was up 4.8%, why are Wall Street analysts completely obsessing over this tiny 0.6% comp figure?
Because total revenue is so easily manipulated. You can just open more doors.
Right.
Like imagine you have a retail chain with 100 locations and they generate $100 million.
Okay.
If you suddenly open 50 brand new locations next year, your total revenue might surge to $150 million.
And a headline reader just sees, wow, 50% top line growth. This business is on fire.
Exactly. But the reality could be that the original 100 stores are actually losing foot traffic. They might be dying, but that decay is totally masked by the new real estate.
That makes total sense. So comps strip all that noise away.
Comparable sales filter out the newly opened stores, the recently closed stores, any massive square footage expansions. It only measures revenue at stores open for more than 12 months.
So it's a pure look at whether the core business is actually growing.
Pure and unadulterated. Freezing the real estate footprint to look exactly like it did a year ago, they still managed to wring out a fraction of a percent more cash from those exact same aisles.
Wow. But getting to that 0.6%, it's a bit of a roller coaster, wasn't it?
Oh, massive volatility month to month.
Yeah, because the quarterly average hides what actually happened. Like in February, comps were up 0.7%. Then in March, they accelerated to a positive 2%.
Really strong momentum.
But then April hit like a brick wall. They dropped to negative 0.5% in April.
Yeah, that April drop was brutal. We're going to dig into the weather dynamics behind that shortly because it's a huge part of the story.
We will. But before we leave the financial blueprints, let's look at margins. Gross margin landed at 33%.
Which is a decrease of 75 basis points compared to Q1 of last year.
And just to clarify the Wall Street jargon there, a basis point is 1/100th of a percent.
Right, correct. So a 75 basis point drop is a decline of 0.75%.
Now, 0.75 of a percent sounds like a rounding error until you apply it to $41.8 billion.
Right, then it's real money.
Yeah, we are talking about roughly $313 million in gross profit, just evaporating compared to their historical margin profile.
And management claims they weren't surprised by this at all.
So where did that $313 million go? Did they just lose it?
No, it was intentionally sacrificed, and it was driven primarily by two strategic realities.
Okay, what's the first one?
First, you have the margin blending from their recent GMS acquisition.
GMS being the interior build materials distributor they bought.
Exactly. When you absorb a massive wholesale distributor like that, their existing margin structure just blends into your corporate average.
Oh, I see.
Wholesale traditionally runs slightly lower margins than consumer retail, so the corporate average gets pulled down a bit.
Got it. And the second reason?
The second, far more critical reason was aggressive price investments in the roofing market through their SRS division.
Price investments. I always love how corporate America just rebrands, slashing prices to undercut the competition.
It's totally a rebrand. It's a deliberate market share land grab.
So what's happening in roofing?
The broader roofing industry experienced this brutal contraction late last year. Shipments dropped a staggering 28%.
Wow.
Yeah, it was the absolute worst quarter for roofing materials since 2019.
So the pie is shrinking.
The pie is shrinking fast, and it's highly competitive. So Home Depot essentially deployed their balance sheet as a weapon.
Meaning they used their massive cash reserves to outlast the little guys?
Precisely. They kept their SRS roofing prices highly competitive. They deliberately compressed their own gross margin just to ensure they kept their momentum with contractors.
Basically starving out the smaller regional distributors who can't afford to take the margin hit.
Right. They gave up pennies on the dollar today to ensure they own the roofing contractor tomorrow.
That's aggressive. And looking further down the income statement, their operating margin sat at 11.9%, or 12.3% adjusted. So these foundational numbers really show a company defending its turf.
Absolutely. Defending it very effectively.
But there is this glaring tension in the consumer behavior data they shared, and I really want to ask you about this.
Go for it.
Management noted that the average ticket size, so the dollar amount a customer spends at the register, increased by 2.2%.
Right.
However, the number of transactions, The actual volume of people checking out decreased by 1.3%.
Yes, foot traffic is down.
So fewer people are walking through those big orange doors, but the company's making more money because the receipts are longer.
That's the math.
Are they just using inflation to mask a dying foot traffic problem? Because a shrinking customer base feels like a massive long-term trap.
That is the exact question analysts hammered them on during the Q&A, because on the surface, higher tickets and lower traffic absolutely scream inflationary mirage.
It feels like they're just charging more for the same stuff.
But the actual underlying mechanics are a lot more complex. Home Depot is currently lapping the worst of the tariff-driven price spikes and raw material inflation from the previous couple of years.
So lumber isn't artificially sky high anymore.
Right. The ticket growth isn't primarily from inflation anymore. It's actually driven by a massive shift in the mix of what is going into the shopping carts.
Mix of products, okay.
While overall transactions fell 1.3%, big ticket transactions, meaning purchases over $1,000, actually grew by 0.8% year over year.
Wait, okay, but they were careful to clarify what big ticket actually means right now, didn't they?
They were very specific.
Because when I hear a $1,000 purchase at Home Depot, I immediately picture a homeowner buying like a suite of new kitchen appliances or luxury vinyl flooring.
Yeah, the classic DIY remodel.
But Billy Bastic, their executive VP of merchandising, he kind of threw cold water on that idea. He noted that large discretionary projects are still under immense pressure.
Huge pressure. The homeowner is not doing that right now.
So who is driving these big tickets? Who's spending over $1,000 a pop?
The pro customer. The contractor, the plumber, the local remodeler. The pro is pulling significantly more weight than the casual weekend DIYer right now.
So what are they buying?
The pro is walking up to the register with complex, multi-category baskets. They're loading up on commercial-grade power tools, industrial pipe, heavy-duty fittings, water heaters, bulk paint.
It's functional B2B purchasing.
Exactly. And simultaneously, the DIY customer is just pulling back. They're making fewer casual trips.
And when they do show up?
When the DIY does show up, they are focusing on essential repair and maintenance, things that are broken, or highly specific seasonal categories.
Which perfectly bridges us into the story behind these numbers.
Yeah.
Because financial metrics are just the lagging symptoms,
Yeah,
right?
I just tell you what already happened.
Right. They're the symptoms of real-world operational choices and environmental realities. If we want to understand the health of this patient, we have to look at the external business drivers.
And the most immediate, visceral driver for Home Depot's first quarter is always the weather.
Always. Retailers love to blame the weather when they miss earnings. It's the oldest excuse in the book.
It is, but for this specific business, the shift from winter to spring is functionally their Super Bowl. It dictates everything.
And this quarter provided a textbook example of the bathtub effect in seasonal retail, didn't it?
It was a perfect case study. In February and March, the northern and western divisions experienced a pretty unseasonable heat wave.
It was warm, the ground thawed early, it was dry.
And when that happens, consumer psychology shifts instantly. Homeowners flood the stores, they start buying live goods, mulch, outdoor power equipment, patio sets.
People want to be outside.
Exactly. That burst of premature spring weather directly fueled that 0.7% comp in February and the massive 2% jump in March.
But then the weather snapped back.
Yeah.
The tub filled with freezing rain.
Dramatically. The final 2 weeks of April brought severe, unseasonal cold and heavy precipitation across the north.
And weekend weather is the absolute lifeblood of the DIY segment.
Totally. You simply do not buy 50 bags of topsoil and start a landscaping project in a freezing downpour.
I certainly wouldn't.
Nobody does. So foot traffic plummeted, and that dragged the entire company's April comps down to negative 0.5%.
But when analysts pressed management on this April collapse, they didn't flinch.
Not at all.
They pointed out that the very second the weather broke in early May, customer engagement immediately spiked right back up to the peak levels they saw in March.
Because the demand didn't vanish into thin air, it was simply deferred.
Right. If your garden needs mulch, a rainstorm doesn't cancel the project. It just pushes the purchase back 2 weeks.
Which is the core mechanism of the bathtub effect. Consumer demand just pools up while the weather is hostile, and then it drains furiously into the registers the moment the sun comes out.
It's a great analogy.
And it's a cautionary tale for retail investors, really. Evaluating a highly seasonal business on a week-to-week basis will drive you insane.
You'll be panicking over a thunderstorm.
Exactly. You have to zoom out, look at the quarter or even half year to smooth out the meteorological noise and see the true demand curve.
That's a huge takeaway. So let's step out of the rain and look at the divergence between the people actually pushing the carts.
The pro versus the DIYer.
Yeah, we touched on it regarding ticket size, but the behavioral gap between these two groups is really widening. And it dictates Home Depot's entire inventory strategy.
It absolutely does.
So on the DIY side, they're seeing intense strength in what I would call immediate gratification categories.
Like what?
They're buying live plants.
Yeah.
They're buying grills. And there is a massive structural shift happening in outdoor power equipment right now.
Oh, the battery platforms.
Exactly. The DIY consumer is abandoning gas-powered tools entirely. They're aggressively adopting cordless, battery-powered platforms from Ryobi, Milwaukee, DeWalt, Makita.
And that is brilliant for Home Depot because it's an ecosystem lock-in. Think about it. Once a homeowner buys a 40-volt battery and a mower from a specific brand, they are deeply incentivized to buy the string trimmer, the leaf blower, the chainsaw from that exact same brand.
So the batteries interchange.
Yeah.
You don't want 5 different chargers on your workbench.
Exactly. And Home Depot dominates the exclusive retail rights for many of these flagship battery platforms, like Ryobi.
Right. You can only get Ryobi there.
Yeah.
But beyond those immediate seasonal hits, the DIYer is just terrified of discretionary spending right now.
The big stuff.
Yeah, the massive room addition, the complete bathroom gut job. Those require tens of thousands of dollars, often financed through credit.
And in the current interest rate environment, the average homeowner is completely paralyzed when it comes to pulling the trigger on those big dreams.
But the pro customer isn't paralyzed at all. Management explicitly stated that the pro outperformed the DIY segment this quarter.
By a wide margin.
So if the homeowner is terrified to spend, who is paying the pro to buy all these water heaters and power tools?
It's a great question. The pro is operating in a totally different reality for 2 main reasons.
Okay, let's hear them.
First, a massive portion of the pro's workflow is non-discretionary repair and maintenance.
Emergency stuff.
Exactly. If your HVAC unit dies in July in Texas, or your water heater ruptures and floods your basement, you do not check the Federal Reserve's target interest rate to decide if you're going to fix it.
You just fix it.
It is an emergency expenditure. You hire a pro, and that pro drives straight to the Home Depot pro desk.
Makes sense. And the second reason.
Second, the higher-end remodelers are working through deep backlogs of complex projects. And these are funded by wealthier clients who are highly insulated from interest rate shocks.
They're paying cash, or they just don't care about a 7% mortgage rate.
Right. They aren't pausing their custom kitchen because of Jerome Powell.
And Home Depot is rolling out the red carpet to capture every cent of that pro spend. They highlighted their Pro Who Paints initiative on the call.
Yeah, that's a big push.
They're trying to break the habit of contractors going to specialty paint stores, right?
Yeah.
So they're expanding their assortments of Behr and PPG products and really pushing these B2B digital ordering platforms like OnePaint.
It's a smart, localized strategy.
But honestly, all of these organic store-level initiatives are just a sideshow compared to the real strategy.
You're talking about the TAM.
We have to talk about the total addressable market, the TAM. Because we are watching Home Depot attempt to swallow the entire American industrial supply chain whole.
It's why this is arguably the most consequential strategic shift in the company's history.
I completely agree. Break it down for us.
So for decades, Home Depot viewed its total addressable market, meaning the absolute maximum theoretical revenue they could generate if they captured every single dollar spent in their industry, as a $700 billion pie.
Which is a staggering amount of money. $700 billion.
It is massive. But through their recent acquisition spree, they just announced they have expanded that total addressable market to $1.2 trillion.
They expanded their potential hunting ground by $500 billion. Overnight. Literally overnight. How do you even do that? You don't get there by just selling more hammers and paint.
No, you get there by stepping outside of traditional retail entirely. You acquire best-in-class, highly specialized B2B wholesale distributors.
Okay, let's talk specifics. CEO Ted Decker spent a significant portion of the call highlighting the recent acquisition of Mingledors.
Right. And to the average listener, the name Mingledors means absolutely nothing.
I'd never heard of it.
But in the Southeast United States, they are an absolute powerhouse in HVAC distribution. Heating, ventilation, and air conditioning.
Yeah.
They operate 42 locations across 5 states.
And HVAC distribution isn't a retail game at all. I can't just walk in and buy a commercial air handler.
Not at all.
Right.
The HVAC market alone represents a $100 billion TAM. Home Depot has always sold, window AC units and basic filters.
Yeah.
But by acquiring a dedicated regional heavyweight like Mingledors, they are signaling a totally different ambition. They want to be the primary supplier for the commercial contractors installing central air systems in massive suburban subdivisions and commercial high-rises.
And Mingledors is really just the latest domino to fall here.
Oh, they've been busy.
They recently acquired SRS Distribution. And SRS is a behemoth that holds leading market positions in roofing, pool, and landscape supply.
Huge footprint.
And SRS had previously acquired GMS, which dominates interior building materials, drywall, steel framing, that sort of thing.
Right.
Do you see what is happening here? Home Depot isn't just a big box store anymore.
They're a supply chain monopoly.
They have systematically bought the roofing supply chain, the landscape logistics network, the interior drywall and framing distribution, and now the HVAC supply lines.
They are constructing an impenetrable economic moat, and it's all centered around what they call the complex purchase occasion.
The complex purchase occasion. Explain that.
Think about the competitive landscape. A local, regional hardware store can compete with Home Depot on selling a gallon of paint or a drill bit.
Sure, they can run a weekend sale.
But they fundamentally cannot compete against an entity that can single-handedly supply the roofing shingles, the HVAC ductwork, the interior drywall, and the outdoor landscaping materials for a 200-home development project.
All from one vendor.
All coordinated through a single, centralized CRM platform and delivered by an owned logistics network.
And the logistics network is the hidden weapon here, isn't it? Ted Decker dropped a statistic that completely changes how you have to view the stock.
The fleet size.
Yes. When you combine Home Depot with the SRS acquisition, they now command a proprietary fleet of approximately 16,000 delivery assets.
It's mind-boggling.
We are not talking about a guy in a rented pickup truck. We are talking about heavy-duty flatbeds. Specialized roofing trucks equipped with hydraulic cranes to lift shingles onto 3-story roofs. Massive box trucks.
Plus a dedicated B2B commercial sales force of over 5,000 associates.
Decker said on the call, quote, "What we are building is unique and not easy to replicate." That is the understatement of the century.
Truly, no competitor can replicate this without a decade of time and tens of billions of dollars in capital.
It's over. They've won that space.
And the ultimate goal of assembling all these pieces is cross-selling.
Right? Getting the drywall guy to buy roofing.
Exactly. Right now, they are in the early innings. The integration between these massive divisions is largely manual. So an SRS roofing sales rep might literally introduce a contractor to a Home Depot Pro desk manager.
Handing out a business card.
Pretty much. But even with that manual friction, they are currently generating a $400 million cross-sell run rate.
Wow.
With explicit plans to double that figure next year as they integrate the software.
They also noted that SRS will now be handling the commercial roofing replacement projects for Home Depot's own massive distribution warehouses. The internal synergies are just wild.
It's a closed loop. They are capturing the specialized contractor who historically viewed Home Depot as an amateur retail store, and they're dragging them entirely into the Home Depot ecosystem.
But what happens to the actual retail stores while corporate is busy playing industrial monopoly? Because those 2,361 big orange boxes scattered across the country are still generating the bulk of the cash.
They absolutely are.
Anne-Marie Campbell, their senior executive VP, provided a fascinating operational update regarding the Mantee initiative, and this completely rewires the labor model inside the stores.
The merchandising execution team, or MET.
Yeah, how did it work before this?
So for decades, the standard operating procedure for a Home Depot Orange Apron associate was to be a jack of all trades.
Okay.
They were expected to walk the aisles, offer expert advice on plumbing, design custom kitchens, but simultaneously they were tasked with unloading pallets, downstocking heavy inventory from the upper racks, building promotional end cap displays, and executing thousands of weekly price tag changes.
It sounds exhausting and incredibly inefficient. You are taking your absolute best salespeople off the floor and hiding them in an aisle, building a cardboard display for drill bits.
Exactly. It degrades the customer experience. If you need help with a complicated wiring job, the expert is busy moving boxes.
So what's the fix?
Management is executing a structural divorce between tasking and selling.
A divorce. I like that.
They are shifting all the heavy lifting, the stocking, the display construction, the overnight merchandising to a dedicated, specialized merchandising execution team.
A meaty.
Right. And this completely frees up the Orange Apron associate to do the one thing that actually drives revenue.
Stand in the aisle, engage the customer, solve their problem, and close the sale. Campbell noted they have aggressively rolled this out to over 1,000 stores already, and they plan to force it into every single store by the end of fiscal 2026.
The initial telemetry is incredibly promising, too.
Productivity metrics on the pure tasking side have jumped, but more critically, customer engagement scores are rising.
Naturally, if you walk into a store totally bewildered by electrical wiring, there is actually an associate available to guide you, rather than being stuck on a forklift 3 aisles over.
It increases the items per basket and builds intense customer loyalty, which is exactly what they need right now.
They are also wringing massive efficiencies out of their digital fulfillment network through a new ship from best location logic.
How does that work?
Historically, online orders might route through a very rigid, predetermined path, like from a regional warehouse. Now, the software dynamically analyzes the order based on inventory availability, delivery speed, and geographic distance.
So it's basically AI optimizing the route.
Basically. Your order might ship from a massive central distribution hub, or it might be picked, packed, and shoved in a van at the retail store 3 miles from your front door.
And Camel reported this logic has slashed cancellation rates, accelerated delivery speeds, and driven customer satisfaction scores for delivery to all-time highs.
So they are squeezing blood from the stone regarding operational efficiency in the stores, while simultaneously bolting on these massive B2B acquisitions.
It's a wildly aggressive dual-track strategy.
It really is.
But Wall Street is a forward-looking discounting machine. The market doesn't pay you for what you did yesterday. It pays you for what you promised to deliver tomorrow.
Always.
So let's examine management's guidance for the rest of fiscal 2026 and the macro headwinds standing in their way.
Well, despite the April weather shock and the clear hesitation of the DIY consumer, management refused to lower the bar.
They held firm.
They reaffirmed their fiscal 2026 expectations across the board. They are forecasting comparable sales to range anywhere from completely flat to a 2% growth for the year.
And total sales, sir.
Total sales growth, which will be heavily juiced by the SRS acquisition revenues and the opening of roughly a dozen new retail branches, is projected to land between 2.5% and 4.5%.
And profitability guidance remains steady as well. Earnings per share is targeted to grow between flat and 4%. They are modeling a gross margin of 33.1%.
And crucially, they are not retreating to a defensive posture with their cash.
No hoarding.
Capital expenditures are projected to hold at about 2.5% of total sales.
Which is billions of dollars.
Yes. They are pouring billions back into the business, modernizing the supply chain and integrating these massive acquisitions. They are literally building the infrastructure for the 2030s right now.
But while the internal guidance projects quiet confidence, the management team's commentary on the broader macroeconomy was highly cautious.
Oh, very cautious. CEO Ted Decker repeatedly referred to the current environment as a period of moderation.
A period of moderation. That is the most polite, sanitized corporate speak I've ever heard for the U.S. housing market is trapped in a frozen gridlock.
It really is. It is essentially frozen.
Yeah.
The parabolic pandemic-era spike in housing demand has completely evaporated, and it's been replaced by the crushing hangover of high interest rates.
Existing home sales are currently languishing below 4 million units annually, which is a historically depressed figure.
The turnover rate, the velocity at which houses actually change hands, is just stagnant.
And housing turnover is the single greatest catalyst for the home improvement industry, right?
It's the engine. A consumer spends the most money on home renovations in 2 specific windows: right before they list a house to maximize the sale price, and the 6 months immediately after they buy a new house to customize it.
Making it their own.
Exactly. If the transaction volume plummets, those massive spending triggers simply vanish from the economy.
Now, I want to push back on this traditional economic logic for a second, because the psychology of the current market feels entirely paradoxical to me.
Okay, how so?
Well, the reason nobody is moving is the lock-in effect, right? Millions of homeowners refinanced into 3% mortgages a few years ago.
Yes, the golden handcuffs.
Exactly. They literally cannot afford to sell their house, forfeit that cheap debt, and take on a 7% mortgage for a new property. So they are financially trapped in their current homes.
Right.
But if you are trapped in a house, you've outgrown, like, say you just had your third kid and you really need a fourth bedroom, but you can't move, shouldn't you be more likely to remodel your existing space?
You would think so.
Right. If I can't buy a bigger house across town, I'm going to finish my basement or add an extension. Why is this lock-in effect choking off big renovations instead of acting as rocket fuel for Home Depot?
The tension you were pointing out is the exact paradox analysts are wrestling with right now. Your read on the consumer psychology is spot on.
Okay.
The trapped homeowner absolutely wants to remodel. The desire is peaking. The friction point is the financing mechanism.
How they actually pay for the lumber and drywall.
Exactly. You do not put a $75,000 master suite edition or a massive kitchen gut job on a standard credit card.
I mean, you could, but you'd be bankrupt.
Right. Historically, middle-class homeowners funded these massive discretionary projects by extracting equity from their homes through a cash-out refinance or a home equity line of credit, a HELOC.
Okay, so when primary mortgage rates were at 3%, HELOC rates were hovering around, what, 4%?
Yeah, capital was virtually free. You could pull $50,000 of equity out of your walls, and the monthly payment was barely noticeable. It was easy money.
But the math on that has completely exploded.
Precisely. Today, that exact same HELOC might carry a floating interest rate of 8.5 or even 9%.
Ouch.
Suddenly, the carrying cost of that $50,000 kitchen remodel destroys the family's monthly cash flow.
So they just don't do it.
The homeowner has the desire to upgrade because they are trapped, but the financing vehicle is totally broken. The massive projects are indefinitely shelved.
Instead, the homeowner redirects a smaller amount of cash into essential maintenance or minor cosmetic upgrades. A new coat of paint, a new grill, some upgraded power tools.
Which perfectly explains why Home Depot's Q1 data shows a collapse in big-ticket DIY projects, but resilience in smaller seasonal categories.
The cost of capital is basically holding the remodeling demand hostage.
That's exactly it.
But Decker and the management team were very quick to point out the silver lining in this gridlock. They argued that while the big projects are paused, the core Home Depot consumer is actually in remarkably strong financial shape.
They really emphasize that. They are sitting on a powder keg of deferred wealth.
The wealth effect.
Right. The executives noted that their primary customer demographic, the homeowner, has experienced an unprecedented wealth effect. National home values have surged roughly 50% over the last few years.
The sheer volume of untapped equity sitting inside American homes is in the trillions. Trillions of dollars.
Furthermore, despite all the macroeconomic doom and gloom, wage growth for this demographic has remained steady and the broader employment market is holding up.
So you have a consumer base that feels incredibly wealthy on paper. When they look at their Zestimate, they have a secure paycheck, but they are simply refusing to take on high-interest debt.
They are fundamentally resilient, just deeply hesitant.
And Decker used this dynamic to flex a bit on the call. He pointed out that while overall retail sales data is shrinking across the country and the broader manufacturing sector is showing negative growth, Home Depot managed to post a positive comparable sales number.
They are actively stealing market share from competitors in a contracting environment.
They're proving they can manage the ship and win regardless of the macroeconomic weather outside.
And taking market share during a boom cycle is easy. A rising tide lifts all boats. But taking market share during a period of gridlock and high rates, that is the ultimate proof of operational excellence and strategic foresight.
Okay, we have ripped through the headline data, we unpacked the story of the weather and the pro customer, and we analyzed the macroeconomic forecast. Now we have to deliver on the core promise of talk tickers.
The bottom line.
We need to distill this mountain of data into a clear, actionable verdict for the retail investor listening right now. What does this mean for your portfolio? Let's get to it.
Based on the totality of this earnings call, the strategic acquisitions, and the macro headwinds, we are taking a firm, cautious bull stance on Home Depot stock.
A cautious bull. I like that.
Right.
Let's break down the bullish side of that equation first. Why should an investor look at this stock and see massive long-term upside?
The bull thesis is anchored entirely on execution and the construction of an insurmountable economic moat.
Okay.
In a genuinely brutal retail environment, Home Depot is executing flawlessly. Simply printing positive comps while the rest of the industry shrinks is a massive green flag.
But the true engine of the bull case is their aggressive pivot into the B2B pro market, isn't it?
Absolutely. The acquisitions of Mingledors, SRS, and GMS are masterstrokes. They're evolving from a consumer hardware store into the central nervous system of the entire American construction and repair industry.
And we haven't even fully explored the financial traps they are setting to lock these pros into their ecosystem permanently.
The trade credit programs.
Yes. During the Q&A, management talked extensively about the expansion of their pro trade credit programs. They are rolling out a system offering large commercial remodelers and home builders 30-day payment terms that trigger upon shipment of the materials rather than at the point of sale.
And if you are not in the construction business, you might miss how revolutionary that is.
Explain why it's such a big deal.
For a contractor, cash flow is a matter of life and death. If a remodeler has to purchase $30,000 worth of custom windows and lumber, they traditionally have to drain their own working capital to buy the materials up front.
Out of pocket.
Right. Then they install them, and then they wait weeks or months to get paid by the homeowner. They are essentially financing the project themselves.
Which limits how many jobs they can take on.
Exactly. Home Depot is stepping in and offering optimized, massive trade credit lines through a seamless digital platform that integrates directly into the contractor's existing estimating software, like Quote Center.
Home Depot becomes an indispensable financial partner. The contractor isn't just buying 2x4s anymore. They're using Home Depot's balance sheet to manage their own working capital and survive.
And once a contractor integrates Home Depot's digital quoting and trade credit into their daily workflow, the switching costs become astronomically high.
They are never going to leave.
Never. They are never going to abandon that slick digital workflow to go back to haggling with a fragmented network of local mom-and-pop suppliers.
That is the bull case in a nutshell. They are building a technological, logistical, and financial fortress that smaller competitors simply cannot breach.
Yep.
But what about the cautious side? What is the bearish argument that stops us from screaming, buy everything now?
The caution stems entirely from the timeline and the immediate macro reality.
The gridlock.
The economic gridlock we discussed is not going to magically unthaw next month. High interest rates are proving incredibly stubborn, and the lock-in effect on housing turnover could easily persist for years.
So you're saying patience is required?
Lots of patience. Furthermore, there are real immediate margin pressures building in the background. Management explicitly flagged potential headwinds regarding commodity input costs and fuel prices.
Fuel. When you operate a proprietary logistics fleet of 16,000 heavy-duty vehicles, a sudden spike in diesel prices takes a massive bite out of your operating margin.
It's a huge exposure. And they also briefly touched on the volatility introduced by new international tariffs, which disrupts pricing predictability.
Yeah, supply chains get messy.
Yes. While Home Depot has historically proven they have the pricing power to pass those costs on to the consumer, it introduces undeniable friction into the system.
So the bearish argument is not that Home Depot is a fundamentally flawed company. The bear argument is that the stock might just trade sideways.
It might be dead money in the short to medium term, while the broader economy painfully digests this period of moderation.
Okay, so this is a foundational long-term wealth compounding play. It is absolutely not a highly speculative tech stock that is going to rocket 40% next quarter on a hype cycle.
Definitely not.
Let's translate that directly into actionable advice. If you are listening to this and you are sitting on shares of Home Depot right now, what is your move?
If you are a current shareholder, you do absolutely nothing except sit back and collect your dividend checks.
Do nothing. I love that advice.
It's the best advice sometimes. The underlying foundation of this business is fortress-like. Look at their capital allocation from this quarter alone. They returned approximately $2.3 billion to shareholders in the form of dividends.
But $2.3 billion in 3 months.
And their return on invested capital, or ROIC, sits at an absolutely blistering 25.4%.
That's elite.
They are an unstoppable cash-generating machine, rewarding their shareholders while aggressively reinvesting in future growth. You do not panic sell a blue-chip behemoth executing at this elite level simply because the housing market is taking a temporary breather.
Agreed. But what if you are a potential buyer? You have dry powder sitting in your brokerage account, and you are evaluating an entry point into Home Depot. What do?
Treat this stock as a premier accumulation play. You are buying a piece of a company that is ruthlessly taking market share during a down cycle.
They're using this time wisely.
They are utilizing this period of macroeconomic moderation to swallow specialized distributors, build an unparalleled B2B logistics network, and completely modernize their store labor models.
They're doing all the painful heavy lifting right now in the dark, so that when the macroeconomic weather finally clears, when the Fed inevitably cuts rates, when the HELOC math works again, and the U.S. housing market unfreezes, they will be perfectly positioned to absolutely dominate the ensuing boom.
You accumulate shares methodically, you reinvest the dividends, and you let the management team compound your capital while you wait for the cycle to turn.
That is the ultimate talk tickers breakdown. We took a $41.8 billion mountain of revenue and stripped it down to the studs.
We covered a lot of ground today.
We really did. We unpacked how a tiny 0.6% comp is actually a brutal flex in a dying retail landscape. We explored the bathtub effect, proving that a rainy April just pushes demand into May.
We diagnosed the psychology of the trapped American homeowner, explaining why the death of cheap HELOC money is killing the massive kitchen remodel, but fueling the purchase of battery-powered lawnmowers.
And most critically, we exposed Home Depot's aggressive, brilliant master plan to swallow the $1.2 trillion B2B industrial supply chain through acquisitions like Mingledors and SRS, locking contractors in with 30-day trade credit and a fleet of 16,000 trucks.
It is a masterclass in capital allocation and strategic patience. They are controlling the variables they can control, defending their margins, and building the infrastructure for the next decade of dominance.
As we wrap up this deep dive, I want to leave you with one final perspective-shifting thought based on the data we just dissected. As you digest all this, I want you to permanently alter how you view this company.
It's definitely not the same store it was 10 years ago.
Because Home Depot is quietly mutating. It is no longer just a consumer big box store where you wander in on a Saturday morning to buy a hammer, some potting soil, and maybe grab a hot dog on the way out.
Although the hot dogs are great.
They are great. But the company is rapidly evolving into a $1.2 trillion industrial supply behemoth that functionally operates as the back-end logistics nervous system for the entire American housing market.
They own the delivery fleets. They own the roofing distribution, the HVAC supply lines, the interior materials, and the financing mechanisms for the contractors physically building the country.
The next time you walk past the lumber aisle or you see one of those massive flatbed trucks rumbling down the highway, ask yourself, are you looking at a simple retail hardware store, or are you looking at the largest, most sophisticated specialty logistics empire in the United States?
It's definitely the latter.
Thank you for joining us on this deep dive. Keep questioning the numbers, keep inspecting the foundation, and we will see you next time.